FICO score required. Next one up is a 581 FICO. We can go down to a 581 FICO. All right. Can you just think about that? I mean, how many people have a 581 FICO or better? That have good credit, that make money. You can document the money that they make. Oh, and you don't have to have any reserves. Okay, you don't have to have 2 months of PITI in the bank to qualify. Okay, that's a lot of people, guys. And this program can help you guys get them qualified. No tax liens. Do you know why we can't have any tax liens? Because the government wants their money first. Who would have thought? I know. The government wants to get paid. So if your clients have a tax lien on their credit report, it's going to come up in the public records. Boom, red flag. I'm going to see it within the first 5 minutes that I'm talking to them. It's going to have to get paid. The reason for that is that if it's not paid, it goes as the first lien position on the house, and then the bank is in the second lien position, and banks don't like to be in the second lien position. We know that right now with the equity lines and your short sales. Right, guys? I mean, how many deals have you had that have been held up for the second lien? A lot. Okay? That's another reason why we're doing these high loan to value 1 loans with mortgage insurance. Okay? So no tax liens. I say no collections because we don't want there to be a lot of collections, but we can review them on a case-by-case basis. But if they have like tons of collections and their credit's just all dark and dingy, and you gotta like wade through it, we're probably gonna have to get those fixed. Not just because of the collections, but because of their credit score. They're not gonna qualify with their credit score if they have a lot of collections on their account. The most I see is medical collections, and utilities. Okay? So these are some probing questions for how you guys can, kind of set yourselves up for your borrowers. Obviously, I can get them pre-qualified, but these are some questions that you can ask to see if they're going to be qualified for credit. All right? I don't want you to go up to your client and say, hey, what's your credit score? What's your life story? What's going on? What do you have on there? But these are some good, easy, conversation topics that you guys can get in there for kind of pre-qualifying and seeing where your borrowers, your clients are going to be.
Medical
medical and utilities, gas. I see SoCal Edison a lot.
Telephone?
Cell phones, AT&T, Verizon, Singular, cell phones, $250 here, pay your stuff. My favorite's the gym memberships. Well, we signed up for a year, and then they just automatically renewed it, and we weren't going, so we didn't know, we didn't get an invoice, we moved. Why didn't they contact us? Well, they don't. If you're not going to the gym, cancel it. All right, moving on. Non-occupant co-borrowers. Okay, you have a couple recently married, just started their jobs, they got out of school. They make good money. They're buying a 3 to 4 bedroom starter house, and they have one of their good friends from college that's going to move in with them and help offset the rent. Okay, their friend's going to give them 3 to 4. Now let's be realistic, $500 to $600 a month in rent for a room to live with them, right? So, well, can't we count that rent? Can we count the rent towards them qualifying? Because it's going to be there. They'll sign a lease agreement. The answer, fortunately, is no. But if you have a family member, a parent who has good credit, low debt, and can help out in kind of increasing the debt-to-income ratio, remember that fun thing? If she doesn't qualify for the house they want to buy, and they just got out of school, they're getting started in their life, and their income's going to be increasing over the next 2 to 3 years. They're not always going to have the renter there, but they wanted to get it into a house and get their life started and take advantage of the market. You can have a non-occupant co-borrower, a parent, go on the loan with them. Remember that if you have one parent, what do you have to do? Count the debt against the spouse for the other parent. So most likely we'll be bringing both of them in on the loan application. So you have a couple people on the mortgage and a couple people on the title. It's no big deal. You can do a quick claim deed or refinance afterwards. Get the parents off of there once they qualify. It's all good. One thing that's not on here I just thought about is that if you're on the mortgage with a conventional loan, if you're on the mortgage, you can be on title. If you're not on the mortgage, you can be on title. But with an FHA loan, can you be on title without being on the mortgage? Jay, what's the answer for that?
No, you cannot be on title without being on the mortgage.
Exactly. You have, if you're FHA loan, you have to be on the mortgage to be on title. Okay. So, I knew the answer for that, Patrick. I was just making sure you're awake. There's a no ratio. You don't have to count the ratio for the non-occupant co-borrowers. There's a typo in there. No ratio. So let's say that you have them come on there on the mortgage and you're using their income and it helps out the primary borrower. There's no ratio for qualifying on the co-borrowers, the co-mortgagers, the parents. Okay. Consumer lates on credit report. Consumer lates, if you're 30 days late on like a revolving credit card, a revolving credit card is something that's paid every month. It has to be paid every month, even if you exceed the monthly payment. Let's say you double your monthly payments on your Visa card last month. There's still going to be a payment due next month. If you're 30 days late, we can review those on a case-to-case basis. But if you're late on an installment loan, like a car loan or a recreational vehicle, or a lease, or anything that is an installment, you have a fixed number of months that is going to be fixed number of months that you have. You have 5 years to pay off the loan. That's not going to look as good because it's a contract. It's an installment loan that you're expected to pay every month. All right. So when we're reviewing the credit, we have to consider these things.